Hey, welcome back everyone. This is Uncle Frank, and I am not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Okay, guys, they're releasing third quarter data suspiciously on a Sunday afternoon, and it's not pretty. U.S. banks are taking massive hits, with unrealized losses on their securities skyrocketing to $750 billion by Q3 of 2024. That's 7 times higher than the unrealized losses reporting during the 2008 financial crisis, where banks faced $100 billion in losses. These losses are tied directly to securities that banks had previously acquired, particularly their available for sale and held to maturity portfolios. A combination of higher interest rates and shaky economic conditions is ripping through the markets, eroding asset values across the board. U.S. banks are feeling the heat, and there's no hiding the financial damage. But what's truly driving these losses? A big chunk comes from residential mortgage-backed securities. Higher mortgage rates have sent the prices of these securities plummeting, throwing banks deeper into the red. The situation isn't much better for corporate bonds and treasuries. Rising interest rates have hammered their valuation, pushing banks' unrealized losses even further. The data doesn't lie. As Bank of America recently reported, their bond losses stand at about $85.7 billion. In the past 3 years, their held-to-maturity portfolio alone has shrunk by $116 billion. Losses in this portfolio are piling up at around $10 billion per quarter. Another important note is there are currently 1,027 banks in the U.S. with assets exceeding $1 billion. Among them, 47 are reporting unrealized losses greater than 50% of their capital equity as of June 30th. Regulators aren't sitting back and watching. The FDIC is cracking down on banks, demanding that they beef up their liquidity stress tests and get serious about managing their uninsured deposit exposure. My ass, you guys let them get into this mess just like you did in 2008. Anyway, the stakes are high. U.S. banks are walking a fine line, and regulators are watching every step. Liquidity stress is the key phrase here. Banks are expected to manage these losses, but that's easier said than done. Analysts are mixed on how things will play out. Some say banks could see up to 25% of their unrealized losses recover if interest rates stabilize or drop, but that's a big if. The economy is a mess, and there's no crystal ball that can predict what will happen next. The market's volatility is here to stay, and banks will have to adapt or go under. There's no easy way out. A brief glimmer of hope showed up when the yield on the 10-year Treasury dropped from 4.34% at the end of June 2024 to 3.73% by press time. So let's talk about that now. The article continues, that's a 61 basis point fall. When bond yields drop, bond prices rise, which helps banks recover some of their losses. But the damage has already been done. Earlier in the year, the 10-year Treasury yield hit a high of 4.48%. The banks that were sitting on these long-term securities when rates were low are now in deep trouble. They thought they were locking in safe returns, but now they're locked into losses instead. I've got that 10-year Treasury yield at 4.09. To add to the financial chaos, the Biden administration's budget deficit hit $1.83 trillion for fiscal 2024, an increase of 8% from the previous year. This is the third highest deficit in U.S. history, surpassed only by the COVID-19 years of 2020 and 2021. The government's total receipts were $4.9 trillion, which sounds impressive, but it couldn't keep up with the $6.75 trillion in outlays. Simple math tells you that's a problem. The national debt is now sitting at $35.7 trillion, up $2.3 trillion from fiscal 2023. The more debt the government racks up, the more interest it has to pay. And that interest is $1.16 trillion in 2024 alone. The first time interest expenses crossed the $1 trillion mark. The economy is buckling under the weight of this debt. Interest expense is now the third largest item in the budget, trailing only Social Security and health care. Looking ahead, the CBO predicts even more pain. The deficit is expected to rise to $2.8 trillion by 2034. On the debt side, the CBO expects it to balloon 122% of GDP by 2034. Do you think this is just a U.S. problem? Think again. From Bloomberg on Sunday, the world's $100 trillion fiscal time bomb keeps ticking. The IMF meetings begin here on Monday. From the article, even before global finance chiefs fly into Washington over the next few days, they've been urged in advance by the International Monetary Fund to tighten their belts. 2 weeks ahead of a potentially era-defining U.S. election, and with the world's recent inflation crisis barely behind it, ministers and central bankers gathering in the nation's capital face intensifying calls to get their fiscal houses in order while they still can. The fund, whose annual meetings begin there on Monday, have already pointed to some of the themes it hopes to press home with a barrage of projections and studies on the global economy over the coming days. The IMF's Fiscal Monitor on Wednesday will feature a warning that public debt levels are set to reach $100 trillion this year, driven by China and the U.S. Managing Director Kristalina Georgieva, in a speech on Thursday, stressed how that mountain of borrowing is weighing on the world. Quote, "Our forecasts point to an unforgiving combination of low growth and high debt, a difficult future," she said. Governments must work to reduce debt and rebuild buffers for the next shock, which will surely come, and maybe sooner than we expect. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.